Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar on analytical procedures in audit. As we all are aware that all these standards on auditing are very important. Today we are going to cover the very important standard, that is SA 520 analytical procedures. And in order to tackle this very important standard, we are having with us very learned speaker, CA Priyanshu Gundana ji. So, on behalf of AASB of I extend my warm welcome to you on this virtual platform as well as a webinar organized by AASB. Welcome to you, Priyanshu ji. We are fortunate enough that we are also having the Honorable Chairman of Bahadurgarh branch, Sri Kunal Vashish ji. So, on behalf of AASB of I also extend our warm welcome to the Honorable Chairman of Bahadurgarh branch, Kunal ji. Welcome to you from AASB of And thanks to Kunal ji for co-hosting this webinar as well as moderating this webinar. In spite of having the bad health, we are thanks that you are here in spite of having bad health for this webinar. So before we, Honorable Chairman as well as Honorable Vice Chairman of AASB of ICI is both are stuck up in other important meetings. So we are taking liberty to start this webinar. And I request Honorable Chairman of Badurgarh Branji to please start the further proceedings of this webinar. Over to you, Kunalji, please.
Good evening, everyone. Thank you, sir. I welcome CA Priyanshu ji. Priyanshu ji is a chartered accountant with 25 years of experience. He is a leading and delivering audit service to clients in broad range of industry across various geographies. He has undertaken such assignment in sectors such as energy, infrastructure, transportation and logistics, oil and gas, pharmaceutical, media and entertainment, chemical, retail and customer etc. He has assigned organization in process design, implementation of internal control, thereby ensuring reliability of financial reporting, effectiveness and efficiency in operation, safeguarding of assets and compliance with applicable law and regulation. He has been a trainer on various soft skill topics like leadership styles, stress management, conflict resolutions. I welcome CA Priyanshu sir. Sir, please proceed forward.
Thank you very much, C. Kunalji. Thank you very much, distinguished members of the institute. I would take this session. I mean, I'll run past my presentation, and then we will do a Q&A where I'll try to answer whatever questions I can. Rest, I'll go back and respond back to you through the to the ICI committee members. So I'll just share my screen. I have a short presentation which I would like to take forward.
Yes.
Yeah, thank you. Hope my screen is visible and my presentation is visible.
Make it full screen.
It's full screen only actually.
Acha, ITT, it is full screen. Fine. It is visible correctly. Fine, sir. Fine, sir. Thank you, sir. Please proceed.
Yeah. Thank you very much. So today, what we are trying to discuss is SA 520, which is substantive analytical procedures. Now, this is a part of our overall audit process. So, what's important and what we'll try to cover in next hour and a half or so is that we'll just talk about an overview of what kind of audit procedures we generally do during our audit process. Then what does substantive audit procedures means to start with, and in substantive audit procedures we have a breakup to say that what does substantive analytical procedures mean, and in that I will try and explain to you what we do at the start of the audit, what we do during the audit, and what we do it at the end of the audit, and the relevance of each of those procedures as we move forward. And the last, I'll just try and see how you apply that guidance on the real time basis. So that's something which I would cover over the next hour or so. When I look at audit procedures and when I look at an audit, I think the first thing which we try and do is to gain an understanding of the business of the company, right? Before understanding the business of the company, we will not be able to move forward, or we will never be able to do a proper audit. Once we try and understand the business of the company, what we try to do is, the next step is actually to do a risk mapping. So after understanding the business, we try and see what are the industry risks which are associated to this particular company, and we try and document that, we try and understand those risks. The third thing then parallelly we do is we try and understand the company's risk. So we must have gone through the last year's financial statements of the company. We must have gone through the media reports which are there available about the company, and try to assess what is the company level risk to that effect. Once we do that assessment of what's the company level risk, what's the industry risk, then we go to a step forward to say that, okay, now I need to try and devise my audit procedure. So for that, I need to have some kind of an arrangement, or some kind of what you call a template, or a guidance to do that. So when I look at that piece, I try and say that, okay, I have the last year's financials, I have the current year's draft, which the management has given to us. Now let's try and see, based on my understanding of the company's risk, and based on my understanding of the industry, what should be the ideal numbers coming out to be from the last year to current year, and try and map those numbers and create a what you call an risk assessment analytic procedures to start with on the top. And then we identify key gaps around it. We think that, okay, this number should be okay, this number should not be okay, and then we divide our audit procedures to address those differences, address those risks. And I'll go into detail as I move forward, but this is just a snapshot of what I'm talking about. So when I look at details and when we actually start doing the audit, my audit actual procedures are technically divided into two parts. One is called as test of controls, which we know. I think we have done various webinars on that, in terms of how you test your controls, what frequency you need to apply, what do you mean by weekly control, what do you mean by monthly control, what do you mean by automated control, what do you mean by manual control, what do you mean by IT dependent control, etc. And we do that control testing. We need to do that because of our IFCFR reporting, also as part of the audit report. The second thing we do is actually carry out substantive audit procedures. Now, that is something which is the key. That procedures, which we call substantive audit procedures, is nothing but the key, what you call audit gathering activities. Okay, in that substantive procedures, we have two types of procedures which we try and follow. One is test of details. Test of details is nothing but actually doing vouching. You need to apply certain methodology, certain process while you select your samples, etc. And then we do that thing. And another way of obtaining audit evidence is to do a substantive analytical procedures, and that's where we will spend some time on how these analytical procedures are conducted, and what are the key themes around it, what are the things which we need to take care as we move forward. Yeah. Now we go to substantive analytic audit procedures. Okay, the auditor's substantive procedures. When we plan our audit procedures, the first and the most important thing is that our audit procedures needs to be demand revived and worked towards a way that we receive comfort at an assertion level for each of the FSLI of the balance sheet and the profit and loss account, cash flow statement, and the notes to the financial statement. So our procedures cannot be just devised randomly. It has to give and address a specific assertion, the risk associated to that specific assertion, and the comfort which we have to gain to mitigate those risks for that specific assertions. Right. So when we do that, we have two ways of actually doing substantive procedures. One is test of details, which I said earlier is nothing but actually going through the sampling method. Now, in that also there are ways of picking up the sample. One is the random way, another is the systematic way. So there are various ways of selecting the sample. You can do target testing, and then you do what you call random selection of sample, non-statistical sampling. So you have various combination which you apply in test of details. Then the second point is substantive analytical procedures. Now, this analytical procedures is the procedures which we perform to gain audit evidence. Therefore, it is very important for us to know that these procedures, when we are performing, it has to be at a very minute or a very disaggregated level. That means we'll have to go into minute of details when we are actually doing these analytical procedures. Of course, our audit judgment and professional skepticism will play a very important role here. So we will decide which substantive audit procedures I want to do for particular FSLI. It may be test of details, it can be substantive analytical procedures, or it can be a combination of both. So it depends upon our way of thinking and our way of actually doing the audit. When we are taking those decisions on which audit procedures to be performed based on our actually professional skepticism, based on our experience, based on our professional judgment, okay, we need to understand how effective that procedure is going to be there at the end of the day, and will that procedure be efficient enough, okay, for us to conclude that my audit risk at that particular accession level is now at an acceptability low level. So that is very important, and we need to document that as we move forward in our audit files. So let's understand, what do you mean by substantive analytical procedures? Okay, I think there is a lot of difference in our what you call risk assessment procedures, which erstwhile used to be called as preliminary analytical procedures, and the final analytical conclusion analytics which we do. So these two are different than what is substantive analytical procedures. And I'll tell you the basic difference before I get into the slides and talk about each of the bullet points. The basic difference is the first and the last just gives you a direction on which way to go and which way you have ended. But the substantive analytical procedure, which is the middle part, actually gives you that audit evidence. Or as I said earlier in my earlier slide to that effect, to say that it helps you to reduce the audit risk at an assertion level to an acceptability low level. Okay, so that is what it talks about. It talks about to say that analytical procedures is investigating the identified fluctuations and the relationship that are consistent with other relevant information or that differs from the expected value by significant amount. Now what does that mean? That means that we are actually performing an audit on the identified fluctuations or relationships. So what does it mean? Identified fluctuations means if the turnover of the company has grown from X to Y, we know there is a fluctuation. Now we need to deep dive on the reasons why this particular turnover has gone up. So that is one. Or the relationship, or I would say that okay, uh, considering the industry in which the company is, the I mean just give you an example, say power industry or a distribution business. I mean their sale or their electricity pickup for April May should be higher compared to winter season. Does that actually fit into the actual numbers which are coming up? And then investigate on those. So that is what it means, right? It is our auditor's judgment, okay, on what choice of procedure we pick up, what method we pick up, and what is the level of application of these procedures on the ground. So it's completely on us. What does the definition of analytical procedure say? Analytical procedures includes the consideration and comparison of the entity's financial information. Comparable information means that we compare the current numbers with the prior period numbers. We also try and anticipate the results based on our knowledge which we have gathered during our risk assessment procedures. Then we also consider the budgets or the forecast of the company and see how that has been devised and how the actual numbers are coming up, or what would be our estimation work based on our calculation. So I'm just giving an example which I've just noted is depreciation. I think we know that there is a block of asset, we know the rate of depreciation, we know the addition date. Just put a formula and we'll arrive an estimate of depreciation number, and we compare that with actual number and see if there is a wide gap or not, right? So there are various ways and means to do it. Industry information, I mean, you will have ratios, entities ratios of sales, account receivable, and you'll also have industry averages, right? If you are working in a particular industry, you will have those various averages. You'll have a lot of publicly available information on various industry, how they are performing, how they are doing it. So you will keep that all thought process, all experience, all knowledge in mind before you actually try and see what the numbers should be and how the numbers can move on. Okay, what now NLA also includes, I mean, this is just this is an inclusive definition, not a kind of a straight kind of a exclusive definition. What it means is basically amongst the element of financial information, right? I mean, the question here is that you would look at various margins around it. It's not only about how an expense move from X to Y. It is also important to actually relate those expenses to certain other key balance sheet P&L line items. Because giving you just an example, if the sales goes up, the expectation should be in a retail and a consumer industry, the marketing or an advertisement expense should have ideally gone up. There is a fixed percentage applied on the advertisement expense to the sales. So is that percentage okay? Is that percentage in line with industry standard? You would try and compare the financial information with the relevant non-financial information. I'm just an example which I try to quote is payroll cost. I mean, you know what is an average payroll cost per employee last year and the current year. Okay, you add that with the number of employees with some increments, and then that you will get some kind of a number, and then you compare those numbers with the actuals. Okay, now there are various methods which we can use to perform analytical procedures. There is nothing which says that only this 10 methods or this 12 methods can be used. While performing substantive analytical procedures, you can think as much as methods you want to think. You have to think out of box. You need to think differently, and then try and analyze those numbers. Because if you're not going to do think differently, then I think a simple variation will not give you that audit comfort. I mean, as I said, the methods actually run from performing a very simple comparison to a very complex analysis using advanced statistical techniques. So there are various tools who help you to do some advanced statistical tinkling, dissect the data, come up with the chart, come up with the pie chart, right? So all these things will actually follow the way we try and do it in the current scheme of things. Okay, when I'm applying the analytical procedure, it needs to be applied on financial statement components, individual elements of the information. Here, it's very important that we apply our judgment, we apply our understanding, because at which disaggregated level you want to go, you need to know and understand that. That will be based on our risk assessment procedures, that will be based on the industry in which that particular company operates, that will be based on certain kind of company's past performance and the way company actually operates on the ground. Just give me a second. Now, as I said to you at the start, analytical procedures are technically used throughout the audit process, and they are actually divided into three as per our auditing standards. The first basically talks about the risk assessment analytical procedures. Now, when I talk about risk assessment analytical procedures, this is nothing but our all good preliminary analytical procedures. Risk assessment analytical procedures are generally performed early in the audit to assist. Now hear this out. It is to assist in planning the nature, timing, and extent of the audit procedures. First, it will assess. It is not an audit procedure which gives you comfort over any assertion or any FS. Sorry, on any FSLI. These procedures are actually used to obtain sufficient operate evidence for significant account or a class of transaction on in terms of how that audit needs to be performed. So this will direct us to select the right audit procedures which will help us to obtain sufficient audit evidence for significant accounts or class of transaction depending upon our materiality. Then we come into the substantive analytical procedures, which will go into detail in the subsequent slides. Basically, substantive analytical procedures are generally conducted during the substantive testing. This is basically very detailed, very robust, right? You can use the risk assessment and substantive analytical procedures, of course, throughout the audit based on the circumstances and the changes which happens. Like just giving you an example, when you must have done the risk assessment audit, I think when you do your planning year before the year end, right? So you must have said for a listed entity, which is needs to be signed off in April or May, you would start your planning typically in January, February kind of time frame, where you pick up the December numbers which are limited reviewed, and then you do some analytics to say that okay, fine, this is the way December numbers are floating in. The expected number for March ideally would be so much. Okay, these are the five numbers which are sure, which looks like absurd, and I need to drill down more or do more audit procedures around it. These are the three or four numbers which looks okay. I can live with low substantive audit procedures around it. So that kind of an analysis you must have done in the month of the Jan or Feb, when you must have started doing the planning. When you are going forward and you are reaching a stage where you are fully into the audit, hitting and bashing, checking vouchers, doing analytical procedures, meeting the management, meeting the client personnel, going out and visiting the factories, etc. You may find certain things where you would feel that okay, let me do the risk assessment again. Let me do that analytics again to give me a fair idea in terms of where I am, in terms of what I need to do further. So every time when you find something new, every time you think that what you thought in the planning and what's on the ground is slightly different, you may want to reassess your risk. You may want to reassess your audit procedures. So that's what it says, that you will have to continue to reassess your risk as and when the audit progresses. Substantive analytical procedures will always be throughout the audit because that gives you a audit comfort to a larger extent. What does the overall conclusion or analytics means, or the final analytical procedures? I mean, just to put it in a plain way, it actually, the purpose of the overall conclusion analytics is to assess the reasonableness of the financial statement taken as a whole. So what it means is basically you have done your risk assessment, you have done your audit procedures, you have got comfort on different FSLI, you have brought in the audit risk to an acceptable low level. Now, when you pick up the financial statements, you will do an overall reasonableness analysis to say that okay, based on what I have done, based on the risk assessment and accordingly planning my audit procedures, I have reached to a conclusion where the numbers which are there is more or less looks like this, and the same is what if I compare with the previous year. I have enough reasons to believe that this is what the number is and this is the number should be. So this is not an audit evidence on significant account balance, but this is basically an overall assessment and the reasonableness of the financial statements, which you will be at the end of the day signing off, right? So the overall conclusion analytics are generally performed at the financial statement level, at a balance sheet P&L kind of a level, where you do some kind of analytic reasoning of the differences which comes in, because you should actually know the reasons at that point of time, because you have already completed the audit in before. So that is the logic behind it, right? Now let me look at each step by step on what risk assessment analytical procedures mean. At a planning stage, we generally perform the risk assessment analytical procedures, and that's basically, as I always said, and I said it earlier also, is to deepen our understanding of the business, okay, and to also direct ourselves to potential indication of risk of material misstatement. It will help you to actually throw some light or focus on certain balance sheet P&L line items, right, which are looking completely different or slightly different than what you had expected. So the way it talks about it, it deepens our understanding of the business, and it helps us to direct our attention to the potential indicators of the risk of material misstatement. Then we actually assess those risks, and then we design our audit procedures to focus on the potential material misstatements. The risk assessment analytical procedures is always helped us or assist us in the risk assessment process, okay, and it is needs to be a well reasoned judgments, and it needs to be clearly identified and documented. What it says, okay, it will really help you to identify the risk of material misstatement, possible risk of material misstatement, let me put it that way. It will identify the significant class of transaction, account balance, and the disclosures and the relevant assertion. It helps us to evaluate the inherent risk factors. It helps us to identify significant assumption and within the accounting estimates made by the management, because when there is an estimate, as we all know, there are significant assumptions which are considered. So that helps us to direct us to those significant assumptions. It helps us to identify the population which we want to test, and also it helps us to identify the and evaluate the untested balances which are there after we have performed the target testing. So again, this part, as I said earlier, means that you are again doing the risk assessment after you have performed test of details on the untested population, to say that do I still carry any risk on that. Okay, so that is something which is this is very important to know. So that's the reason why we say that risk assessment procedure needs to be done continuously as we progresses in the audit procedures. Now let us talk about the nature, timing, and extent, and what does that mean. So it says that when designing and performing a substantive analytical procedures, either alone or in combination of test of details, the substantive audit procedures in accordance with SA 330, the auditor shall, okay, determine the suitability of a particular substantive analytical procedures for the given assertion, taking account of the assessed risk of material misstatement and test of details. Now, what does it means? It means that before you say that I want to do an analytical procedures, you need to determine that is the analytical procedure suitable, and that will help you to mitigate the risk of material misstatement and bring the level of risk of audit at an acceptably low level, is something which you need to decide, okay, and then go forward. The second most important thing is that reliability of data. Now, what does it mean? I mean, when you are doing an analytical procedures, you are going to rely on multiple data points. The question will come up is that from where this data has been actually extracted. So, for simple example, if you are extracting the data from the management system, then two things you'll have to do, right? You will have to look at the controls around that particular data in terms of the way the account data has been put into the system, right? Who approves, who checks, who balance, etc. kind of it. Also, what you will say, the system per se, how reliable that system is when it comes to data extraction, which means that is there any loophole, is there any kind of what you call super user access where data can be changed after it has been approved or after it has been entered, is it a possibility of a backdated entry going into the system, and many such kind of controls and balances, I would say, which needs to be kept, right? So, so it is very important that we evaluate the reliability of data from which the auditor's expectations of recorded amounts or ratio is developed. So basically, from where the data is captured, we need to understand the controls around it, the comfort around it, right? So that is what it is, and that would be based on the nature and the relevance of that particular information as we put forward. The third is based on our risk assessment, based on our knowledge, based on the business in which the company operates, based on the data which we have captured, right? We should try and develop an independent expectations. Okay, developing an expectation of a recorded amount or ratios and evaluate whether that expectation is sufficiently precise or not is key to identify material mistake. And the reason why I'm saying is key is that based on what you have developed an expectation, and that expectation you are going to compare with the financial numbers which company is going to give, and the difference is what you are going to investigate in detail. So developing an expectation is very, very important. And when you are developing an expectations, you are trying to actually collate information from various sources. So when you're collating information from various sources, you also need to actually document and be clear on how those sources have actually collected information. Oh, that sources are independent sources. So what is important when you develop it? Collecting information from an independent source. So you have to document, you have to evaluate if that particular source is independent enough to give you that particular comfort while developing the expectations with that. And of course, the fourth point ideally would be is to determine the amount of any difference between the numbers which management has given, which is the actual financial numbers, and your expectation number. You need to investigate those difference to an acceptability low level. Now, the question everybody would ask is what is that difference and how much I should evaluate? So that completely, again, I would say is depending upon the kind of business in which the company is. So just give you an example. First is that if the company is into a retail and a consumer business, I mean, they will have various products, right? They will have a soap. Under soap, they will have five types of soap, different packaging types. They will have similar product like a beauty product along with this, or different kind of activity, different kind of healthcare product. So when you are doing your analytical procedures, which are substantive analytical procedures, ideally you'll have to do it at a disaggregated level, and that means for each of the soap class, you may have to take the numbers from the management, develop an expectation for that particular soap class, get the difference, and then investigate. When we are looking at investigation, your materiality will play a very important role, right? You don't need to investigate every and single number, right? If the number is below materiality, you still have a comfort to say that your judgment is going right. So materiality will play a very important role in this picture. So if an analytical procedure is performed in accordance with this ISA or SA, identify fluctuation or relationship now, that are inconsistent with the other relevant information, or that differs from the expected value by the significant amount, the auditor shall investigate such differences. Right? So what it says is basically it talks about it's a technical line, but it talks about three or four things. It talks about okay, perform an analytical procedure under SA, and you will identify a fluctuation. So first, you have identified the difference, step one. Okay, or a relationship, which is maybe a ratio or something like that, right? Okay, and that is inconsistent with other relevant information. That means any other relevant information which you would have captured while creating an expectation, or it differs from the expected value, which is what you have done in as I said in step 3, right? By a significant amount. And what is the definition of significant amount? I would rather apply materiality to that effect, right? What is the materiality, and how then significant that amount is vis-a-vis the materiality of the company. The auditor shall investigate such differences, okay, by inquiring with the management and obtaining sufficient audit evidence relevant to the management response. So what it means is that first you will go to the management. Management will give you an answer to these particular differences. You then independently verify those answers with the facts, figures, numbers, and underlying supportings. Then you also perform other audit procedures as you may feel necessary, depending upon the circumstances, depending upon the difference, depending upon the complexity it is involved in. Now I would rather talk about something on substantive analytical. What are the types of procedures? Now we talked about the four step. We talked about basically what is the steps that you need to follow, kind of that. So now let's talk about what are the substantive types of substantive analyticals before we go to the four step approach which is there. So when I look at substantive analytical procedures, the type of procedures which are available, which are there on the ground, there are five types of procedures. One is trend analysis, then we have ratio analysis, we have reasonableness testing, we have regression analysis, and we have scanning analytics. The five type of the defined about analytics is ranked from lowest to highest in order of their inherent precision. What does it mean is that in terms of the level of comfort and the amount of comfort you will get, it will be the highest when we do a scanning and will be the lowest when we do a trend analysis. So that is what our takes about. And scanning analytics are different from other type of analytics, in that the scanning analysis searches within the account or other entity data to identify anomalous individual items, while the other type uses aggregated financial information. What does it mean in a very simple term? Scanning analytics is general ledger scrutiny, right? You pick up a ledger account, you do the scanning, you do the analytics, you go through that and identify if there is any anomalous individual items, any outright individual items which are glaring, right? So you actually perform that kind of rigor while you're actually going through the ledger account or a ledger scrutiny when we do it. So let's talk about each of the analytics one by one, kind of it. First, let's talk about trend analysis. This is the analysis of changes in account over time. What does this mean? It is basically kind of simple analysis or a fluctuation where you compare prior year's period account balance to the current year period. Okay, or you may try and do some kind of a trend analysis where you try and compare multiple time periods and then see the trend in terms of way the numbers are floating in and the way the numbers are working on, and accordingly you will take it forward in and then arrive at a conclusion. When is trend analysis appropriate? Trend analysis is appropriate when the account or a relationship is fairly predictable, okay, and it is less effective to change when the entity is having a and the significant experiences. So what it says that you have a steady business, for example you have a steady contract with the party to say that x number of units I'm going to sell to you. I mean, this looks good when you're doing, for example, an audit of an auto component company where you have a steady thing that okay, you are supposed to, depending upon the orders which you receive from your depending on the cars which are getting sold, you know that this much quantity could have been sold from your end. So trend will actually show you in terms of the way cars sold is high and what is your trend, is this in line or not. Yeah, so it is a very predictable business. You can actually easily predict what that numbers could be, right? Okay, the use of only prior year balance as an expectation in trend analysis reduce the effectiveness. So what it means, and I said earlier, saying that just to compare two numbers would not really give you comfort. Because remember, when you're doing substantive analytical procedure, you are gathering audit evidence. You are not trying to just understand the business or trying to assess the risk, right? Here you are actually getting audit evidences. So comparing two numbers, two prior year numbers, or two columns would not help. I mean, ideally, also when we look at any annual report and when we see a 10-year analysis trend, we try and understand better, right, in terms of the way the company is moving, way things are moving forward. So that is what is the reason why when you're doing trend analysis, it is more better to have more than one period when we do the analytics. So what this means is because the trend analysis relies on a single predictor, that is prior data or a year after, it does not incorporate the use of other potential financial information or operating data, right? So you don't use different combinations, you don't use different ratios, kind of it, right? As other type of analytics would actually do it on the ground. This is a now let's go to this the second type of analytics, which is ratio analytics. Now when I look at ratio analytics, when I look at ratio analytics is also to some extent like trend, but it is slightly more robust because you would actually try and link three or four financial numbers with each other and come back with the trend, right? So it is like you look at advertisement revenue, as I said earlier, to your sales, or you look at a gross margin to your sales, or you look at inventory to your sales. So there are various pointers under which you would look at it. You will consider non-financial information, right? Number of units sold, versus the revenue, or when you have a steady price. So these kind of external benchmark comparison, relationship benchmark between financial statement accounts, relationship between financial and non-financial information is gives you larger comfort. So that's what we do it in, basically, ratio analysis, right? When we again, when we do our ratio, we try and compare a general PBT kind of a ratio or a EBITDA kind of a ratio with what is the industry benchmark. So again, you are trying to look at a number which is outside the system, outside the company, so it becomes more authenticated, more reliable to that effect, right? More independent, if I have to say that. So that's the reason why we say that ratio analytics can be more effective than trend analysis, because the comparison between the accounts can often reveal unusual fluctuations, right? Depreciation percentage on a gross to gross basis, or employee cost was divided by number of employees. If there's a vast variation, I think you would like to look at it, right? But maybe trend would not throw that out, because trend would show that okay, your payroll cost has gone up 10% year on year, which is in line with your inflation. But technically, your 10% payroll cost has gone year on year, but your employee strength have reduced to half, or it has been to double. Then there is something different, something important to look at it, right? So that's what I'm trying to say. Okay, now when you're benchmarking ratios with competitors or aggregated industry data, okay, it is very important that these data are basically comparable. So you should compare likes to likes. That is what is important, right? Like trend analysis, ratio analysis at a disaggregated or an aggregated level will relatively impress, because significant difference is often small relative to the nature of variation in the ratio. So basically what it means is, basically when you try and do any analytical procedures at an aggregated level, it will not help you as much as what you do it for a when you do it at a disaggregated level. If I have to take some of the examples of ratio analytics, as I said, I think elements of income or loss as percentage of sales, you take a gross profit turnover, account receivable to turnover, inventory turnover, profitability, leverage, liquidity. Mind it, I mean, when you are doing this particular analysis, it's very important to know under which industry you work. Without knowing the industry and without knowing the key parameters of this that particular industry, you will not be able to do an effective ratio analytics. So that's a key behind it. Now let's me move to reasonableness testing. I think this is something which we do it quite regularly, right? And just to keep it very simple, depreciation. So what does this reasonable testing means? This is an analysis of account balances or changes in account balances between the account period that involves the development of a model to form an expectations. Now, what does that mean? And I can use both financial and non-financial kind of a data. What does that mean? I mean, it's simple, right? I can, based on certain line items or certain parameters, I can predict a number for the third one. Okay, it is a simple model, can be sufficient, right? But just giving you a very simple example, I mean, you know, what would be an average rate in a hotel room, and I'm just taking that example which has been shown in the screen. I'm trying to make it simple here. Is that basically I try and take that average rate per room which I'm going to charge. I look at occupancy and I'll come up back to, okay, this should be your average revenue to that effect, right? So and based on that, I would then look at other client items to say that if your occupancy is 25% or 30%, your consumption of shampoos and other related stuff should be ideally to that extent. So there are various other service, what do you call, FSLI, which gets impacted to that effect, right? Just to give you an example, to say depreciation, I'm just giving you a very simple example, right? You do a reasonableness analysis based on the fixed asset register you have. You can do a reasonableness analysis, right? You can identify what would be the depreciation amount, and then compare that with what is actuals, right? To come up with a number. So that is something which is really helpful to do that, right? Payroll is one of the easy model to write. You can very well model it. Basically, you can have the average rate, number of people, termination rate, and then arrive at a number. So I think these are line items where there are two denominators, now numerators, which can be independently verifiable and can be used combined to come up with a number. That is something where we look at reasonableness testing. So reasonable testing actually relies on our knowledge of the relationship and the factors that affect the account balance, right? Use of knowledge to develop an assumption is a key factor here. So as I go back again to the first point, to say that as an auditor, the first thing which we need to understand is the business in which the company operate, the industry in which the company operate. Without that, all these things would not make sense, right? So a reasonable test of sales could be performed. I mean, just taking an example, right? By considering number of units sold, unit price by product line, different pricing structure. But that is only possible if you are able to understand the industry in which it operates. So a real estate process cannot be applied to what you call retail and consumer, right? Because there the whole way of calculating the revenue is different than what way you are calculating revenue at a retail and a consumer industry. So that's the key if I have to look at it. I mean, just to share you some of the examples. Interest expense on borrowing, very simple. 100 crores term loans taken, 12% interest, it should be this much in the P&L. Raw material consumption to production ratio, this is something which is available in all the companies when they are doing the costing. Just try and understand, okay, fine, your production ratio at the start was this much, now it's this much. What is the problem? Scrap to the material consumption. I mean, this is something which is quite common, which we look at it, right? What is the scrap value which is generated out of your production? It cannot range between X depending upon the industry in which you operate. Sales discounts, commissions against sales volume is a percentage. Again, you can predict based on your volume. Rental revenue, very simple. You have a premises occupancy, you come up, you have an agreement which gives you the rate, so you apply those and you will get those numbers out. So that's what it is. Let me move forward. It is now going to a second thing which is called as regression analytics. Okay. Now this is one of the most complex, I would say, analytical model. Uh, it is a statistical model to quantify your expectation and measure your risk at a precision level, right? So you're using a complex forecast modeling kind of a systems. You're using a package to give you throw out some kind of bars, pie charts, effectiveness kind of a, right? So that's this, you may form an expectations of sales by using a model of input such as management sales forecast, commission expense, advertising expense. Use some Excel based spreadsheets, use some standard software, and then come up with a regression analytics which gives you the whole flow of transactions, right? So regression analysis actually is similar to reasonableness testing in that the only thing the model yields are specific and explicit, right? The prediction of using input based is there. Then again, it's very important that it has to be based on our knowledge in terms of what are the factors which gets affected to that account balance, right? A regression analysis is very effective when the data is disaggregated from the system, okay? and the system which from where the data is getting extracted has a good internal control and has a strong predictable relationship between the two data elements. Okay, that will actually play a very important role when you are performing regression analysis. So as I always say, I mean, before I go to the last one, you need to select which analytical procedures you want to do. But what is important is you need to also understand which is best suited for that FSLI. So you can use multiple analytical procedures for the same audit for different FSLIs for different line items. So that's absolutely fine. Let me move forward. The last one, which is basically to talk about, is the substantive analytical procedures on scanning analytics. Now, I mean, this is quite simple, straightforward. It is nothing but an ledger scrutiny in different forms and ways which do it. This is identification of aluminious individual items within the account balance or other data which is there in this in the financial information of the company using the scanning, or that means you look at the entries listed, you look at subsidiary ledgers, you look at general ledgers, you look at adjusting entries, you look at the suspense account, you look at the reconciliations, other reports which comes out, and then come up with to say that okay, is there any unusual unexpected transaction which comes in, right? Scanning analytics is different from other types because which is used at more macro level and it is top down focus. Scanning analytics include searching of large. It's not about only unusual. It is also about large material transaction, unusual transaction, as I said, unexpected items in the accounting record. But simple like non-standard entries in a cash and bank, you are having a JV. Ideally, you should not have a JV in cash and bank. So this is our like non-standard JVs, as well as review the transaction data or for indication of errors or any such kind of stuff. So that's what you do when you do scanning. So while some scanning analytics may be performed manually, you can use various softwares, various CAS which is available in the market, which throws out unusual items, which throws out large items, depending upon how you have set the parameters for that particular computer assisted audit techniques, which is called CAS, when it runs on the software packages. Okay, the expectation form from scanning really would depend upon the purpose of the procedures. The expectation of scanning of large and unusual or unexpected item is, as I always said, is basis our assessment, basis our materiality in terms of the way we look at it. What is normal for us? A transaction may be a normal for one type of industry, but may not be normal for another. So it is completely auditor's judgment to determine, to conclude, is this transaction normal or unexpected. So that comes auditor's judgment. Scanning analytics may include the following types of tests actually. Okay, this is not the inclusive or an all inclusive test, but this is just a kind of examples if I have to put it across. You can look at unusual items, scanning transaction, listing, closing, adjustment entries, large unusual items. You can also look at gaps, identifying missing items, right, by reference of sequential numbering or a consistent pattern. If you say that okay, I have invoice numbers which are getting generated on a sequential basis, then you just look at that sequential numbering to see is there any gap on that. Duplicates, duplicate invoice numbers, payments, payroll transactions. I mean, this is something which we always look for. Is there any such kind of transaction? We look apply filters. As I said that when you are using a computer audit technique, you need to apply filters, non-standard journal entries, accounts under dispute. What is the movement which is happening? Transactions with related parties, inventory which is non-moving, raw material which are in obsolete nature, any collections after period end date, any invoices raised after period end date. Okay, you can. then do a sort basis to see if any kind of suspense accounts are there or any specific transaction which you want to sort for. Aging, you can look at invoices about 90 days. What is an issue? Inventory about 90. All current assets above X number of percentage have. What is the reason why that's outstanding? Then you apply parameters, ECL modeling, etc. kind of it. You look at classifications. I mean, is this particular balance classifying properly? Is this account should be a credit balance or it should be netted off against debit balance? It should be a non-current, current, etc. kind of it. Stratifying, categorizing the data based on the characteristics of population. For example, like uh, employees by overtime, why that employees got so much of overtime, or group of customer accounts, etc. So these are the type of a test which we can perform while we do a scanning analytical procedures. Now let me move to the four-step process which I just touched upon earlier, but it's very important we go into a little bit more detail on this before we close for question answers. When I look at four-step process, uh, uh, there are four elements that distinctly identify each processes, right? And what does that mean? Okay, let me start with the first thing. Okay, determine suitability, access, reliability of underlying data, and develop an independent expression. Anything in analytical procedures, when you are doing in substantive audit evidence stage, the first and most important thing is that you need to develop an independent expectation. And as the word talks about independent, which clearly means that the data which you are going to use needs to be independent, right? So let me look at it, right? What are the things which you will look at it in this case? Okay, the reliability of data is actually influenced by its source and the nature. Okay, and it depends on the circumstances under which it is obtained. So what is important here, right? The source from where the data is, what kind of a data, and from where you have obtained it. So this is something which is very important, which you need to document and get comfort on before going forward. Okay, source is the information available. Okay, that is basically the information you have. Okay, from where it is available, right? Compatibility of the information available. Okay, can you use those information to compare and collaborate, right? Is that information relevant in terms of the nature, timing, and extent, right? Is it backdated? It is outdated. Sorry to say that. Okay, if I use budgets as one of the independent source, how the budget is prepared, what are the key parameters, what are the key things which went into that particular budget, how robust that budget was, how independently that budget was prepared, was there any kind of an influence from anybody while preparing the budgets, right? And the third is you'll also look at basically the controls over the preparation of the information. So basically, if I'm taking an information from somebody, I mean, we also need to assess is their information securely obtained? Is that information not subject to tamper? So there is a control mechanism which we need to check around those information which we need to receive, kind of it. Okay, developing a appropriate, precise objective expectation is the most important step to effectively use substantive analytical procedures. This is something which I've been saying and I've been repeating in my slides because that is the most important thing when you do a substantive analytical procedures. An expectation is a prediction, right, of a particular amount or a particular ratio. Prediction can be anything, right? It can be a specific number, it can be a percentage, it can be a direction, it can be an approximation, and it depends upon the desired precision, right? It goes up, goes down, whatever it may be, right? So that is what it is. Develop an expectation by identify possible relationships. So it is very important that you are able to identify the relationship which has a link between both of them. Okay, and they are reasonably expected to exist based on the knowledge of the business, industry, trend, and other accounts. So the information source for developing the expectations may be last year's numbers, relationship with the financial data, in relationship between elements between financial and non-financial informations. Now, I mean, before I go into this threshold, I think what I again like to say that when you are developing an expectation, what is important is the reliance you place on an independent data source or relationships between two FSLI will give you better comfort than just comparing the two between two numbers from last year to current year. Now let's talk about the significant defined significant difference or threshold. The maximum acceptable difference that can be expected without further investigation is called as threshold. The threshold is defined either in numerical value or percentage term. Now it depends upon which way you want to look at it, right? The threshold would generally not exceed the materiality level when you are performing the substantive analytical procedures. So what's important here is basically that when you are doing a threshold of revenue, okay, ideally you will have a variation of say 300, 400 crores on a 10,000 number, but your PBT and the materiality comes to 50, then this whole analytical procedures will not help technically because you will have a difference which is more than 50 when you're talking a large item comparison. So you'll have to be very mindful on what you need to do, how you need to obtain, and what are the things which you need to take care. So primary factors which you need to consider while defining the threshold are the desired level of evidence from the analytical procedures, the precision of the expectations, the materiality level, including the impact at disaggregated level, and the type of analytical procedures which you have used, and the rigor which is applied on that particular analytical process. Sorry. I mean, this is kind of the most simple step if I have to put it across. Computer difference. The third step is actually comparing the expected value which we have with the recorded amount and identify the significant differences. This is simply a mechanical calculation, right? It is important to note that the computation of difference is done after considering the expectations and the threshold. So again, as I said, out of this four process, if you don't get it right, the first and the second, third is just a match, you will not be able to do fourth properly, right? So it's very clear to say that you first you I mean the point what I would like to say in the last point which I'm putting is that you can't start with the third and then go with the second and the first. Means you take a last year number, current year different, identify the difference based on the last year number which you have developed an expectation, and then you have developed a threshold based on materiality, and then you say it's not material. That cannot work. You have to build a different independent expectation, threshold based on materiality, take the current year numbers and identify the difference. And then you decide which difference you want to actually further investigate. So when I look at that, there are the how you investigate significant differences, right, and form conclusion. Now this is where you are actually going to get audit evidence. The differences indicate that there is an increased likelihood of misstatements. The greater the degree of precision, the greater the likelihood that difference is a misstatement. What it means is if you have done the work in a very precise manner and still you have got a difference, then yes, there is some problem which you need to look at it. Right? So there is a chance that there are unexplained difference may indicate an increased risk of material misstatement. Okay, in addition, while it is instance, the potential misstatement would be less than the performance materiality, the example which is there. There is a possibility that the combination of misstatement in specific account balance or a class of transaction or other balance or a class could aggregate be unexpectable amount. So what does this mean? Very simple para I'm saying. Okay, one line item you will find that okay the difference is lower. But if I add that class of item, right, or aggregate that account balance or that class of transaction, and the difference becomes higher, then the question is that mixed likelihood of misstatement is high. Then you will have to investigate each of that line item as you move forward. So it is important to show a clear audit path between our original estimate and the actual figures, including the impact of additional factors not included in the original expectations. This can be done by documenting the impact of new data when explaining the difference and producing the revised expectation. Okay, what does this mean? This means that, okay, fine, you have developed an expectation, you have got the difference, you start investigating the difference, start talking to management, look at the data, or you find, okay, there are certain parameters which I have considered while doing expectation is not correct. You revisit that parameters and come up with another expectation line item and then relook at it. So till the time your risk is not reach to an acceptability low level, that whole investigation process will have to continue. Inquiry is frequently an important aspect for identifying the difference, but this is at the start. Okay, management inquiry will not alone support the explanation. You have to look at underlying documents, underlying paperwork, right? So let me lose that. Now we have done our work. We have done our risk assessment analytics, basis which identified risk. We did our substantive analytics. We came up with the financial statement numbers which we find it comfortable with. The risk of material misstatement is at an acceptably low level. All well. Now let's do an overall analytics. And what does this gives out? This actually throws out that whatever numbers you have come up with while performing the audit is what looks appropriate when I look at the overall financial statement presentation. So this is not an audit gathering activity as such, right? This is basically to help you for the overall conclusion. So overall conclusion analytics are typically performed at the financial statement, not at disaggregated level. So we are not here going at a disaggregated level. We will look at overall property, plant and equipment, okay, current assets, non-current assets, revenue, payroll cost, other expenses, raw material consumption, etc., kind of, right? This is basically just to say that we have gathered enough evidence for any unusual, unexpected balances, right? And there are no unusual, unexpected balance sheet which are unidentified. Yeah, our this analysis actually helps us to conclude and arrive that all significant differences are very well explained. Okay, we have got comprehensive understanding of the financial statements, including the interrelationship between them, and the overall financial statement presentation which has been done makes sense based on the audit knowledge which we have got, based on the understanding of the businesses, based on the understanding of the knowledge which we have for the industry. So this is an overall analytics which gives you a kind of a comfort to say that what we have done is what is reflected here. Okay, so I'll just go again with key points before I open up for questions. This is my last slide. Basically, to say that again, it is very important that you understand your business. Using appropriate knowledge source is very important because that's how we can develop our point of view. Okay, and try and link back to the business risk faced by the company. Okay, this will help us to identify the key performance indicators, key value drivers, and plan our analytical focus accordingly. During our performance of analytical procedures, we may identify gaps okay, between peers. This is particular true when we are using external knowledge and benchmarking tool. These gap areas as potential areas of improvement. So here, when we are trying to do this analysis, there is a possibility that we can add value to our clients. We can give them recommendations. We can help them to be better. So it serves both our purpose to that extent. So thank you very much. Happy to take any questions. I'll just be off the slides now. Happy to take any questions.
Yeah, thank you so much, sir. Thank you so much, sir. Can you hear me?
Yeah, yeah, sir. I can hear you, sir.
Thank you so much, sir, for such a nice deliberation. Sir, the two or three members are just asking can you give at the end just a gist or at a major points for this particular analytical procedure
Sure. So
in
I
a gist
would
in a nutshell manner?
So I will explain to you only in two I mean 2 minutes kind of a nutshell,
Yes,
right?
sir.
First, try and understand the business of the company. Try and understand the industry in which the company operates. That's the first thing which I'll tell you to do. Second thing is when you develop an expectation, use those analyticals, use those knowledge, and come up with an independent number for that particular company. When you are calculating the independent number and when you are relying on various parameters to calculate, ensure that the data which coming in is properly protected. So what I'm trying to say is do the analytics, get the understanding of the business, use that understanding of the business, use external data, come up with an expectation numbers, then compare that expected number with actual numbers. There will always be a difference. You should identify the threshold under which you don't want to investigate, above which you want to investigate. That will depend upon the materiality. Then you do an investigation. When you are doing an investigation, you don't need to actually go and only do management inquiries. You have to look at underlying information and data, because the most important thing when I'm putting it across is that this is an audit procedure step. It is not a comfort step beyond a point. So substantive or analytical procedures is an audit evidence gathering activity, not the final and the preliminary analytics procedures to that effect.
Yes, yes. So, is there any source where the comparable data available other than the ROC filing data?
So there are a lot of reports which are issued. So it depends upon industry to industry. I think there are a lot of reports which are issued for that particular industry by CII or various other forums. You can use that as an information or data. I think there are a lot of such magazines and all which companies actually subscribe for their reading and their understanding. I think you can use that data to build an independent expectations to that effect. So there is no hard and fast rule in terms of you need to use only ROC data. In fact, ROC data would not help you much because it just gives you a previous year numbers, right? That may not be an
Yes,
independent source to that effect. So it's
yes,
very difficult to actually implement analytical procedures, substantive analytical procedures and audit comfort, if you ask me frankly.
yes, yes, sir. So while this analytical procedures in auditing, should we also consider the seasonal impact?
Yes, yes, everything, everything. I mean, I gave an example of a power company. You will find a steep rise in unit consumption in April and May, and may not be such a steep rise in say December, Jan for retail consumers. I mean, you have to look at industry trend and data. Otherwise, that will not help. Seasonality. If somebody is into agriculture business, you would look at numbers moving up and down, right? So that's very important.
Yes, yes. So using analytics is extremely useful, but with involved with additional cost for an audit. So how do we convince the management that it will work for them?
No, so as I said, that's a basic challenge, which is the why people
Yes,
prefer test of details more than analytics, because analytics involves a lot of judgment, right? Lot of explanations, lot of use of tool technologies, kind of it. Because you are trying to independently prepare. I mean, I would not say prepare, but you are trying to independently actually portray the P&L and the balance sheet of the company, and then compare with the actual numbers, right? So there is this thing which is a lot to that effect. So it's
Yes,
very difficult. I think you'll have to talk to our clients to say that are they ready to pay a fee for those kind of investments.
yes. Sir, what will be the impact of AI on the analytical procedures, artificial intelligence?
A lot, a lot. Because the AI would help you to capture data from various scheme of things, various portals, etc. Put it into one place. Give you an overall view, give you a pie chart, give you a snapshot of what's going on throughout unusual items. It will play a very important role as we move forward.
Yes. Sir, while doing this SA 520, it will impact other essays also while doing this auditing. If we are following SA 520, so what will be the other essays which are relating to SA 520, relating to
So
analytical procedures?
So I cannot specifically pinpoint that question around it and answer it, because my point of view here is that all essays are interlinked,
All are
right?
interlinked, yes.
All are interlinked, and every essay has an impact and has a carry forward from other essays. So it is you will have to ensure that you are in compliance with all essays, and they are so interlinked that while doing one thing you may be to some extent trying to comply with others. So I mean, there is no specific hard and fast kind of a linkage to say that if I do 520 I will be compliant with 330 or 220 kind of it.
Yes. So last question relating to AI only. Will modern AI tools shorten or replace the analytical procedures?
Analytical procedures is a procedure basis which you are going to obtain audit comfort. Using modern AI tools is a way to develop expectations. So it can never replace your audit procedures. It can actually suit, help, support to carry out audit procedures in a more effective way and bring out conclusions which may be more comforting and may be more reliable. I will put it that way.
Yes, sir. Yes, sir. So thank you so much, sir. Now we come to an end. It was wonderful deliberation, and you have covered all the related questions. And on behalf of AASB of I extend my heartiest thanks towards you, sir, for sparing your valuable time. In spite of having busy schedule, in spite of having this audit season and various committee meetings also, you have given your kind consent to for this wonderful session. So, on once again, on behalf of AASB, thank you so much, sir. Thank you so much.
Thank you very much,
Thank
everyone.
you, sir.
Thank you.
Thank you, sir.
Thank you.
Thank you.
Thank
Thank you.
you.
Thank you.